Fundamentals of algebra in business. Algebra provides the foundation for quantitative methods in business. Essential concepts such as variables, equations, and functions enable professionals to model scenarios and evaluate options effectively. Problem solving with algebra. Algebra equips business professionals with problem solving tools necessary to navigate complex challenges. It allows for the formulation of equations that represent real world situations essential for strategic decisions. Applications of algebra in financial analysis. Algebra plays a vital role in financial analysis, enabling the evaluation of income statements, balance sheets, and cash flows. By utilizing algebraic formulas, companies can forecast revenues and assess profitability effectively. Algebra and inventory management. Utilizing algebra and inventory management helps businesses balance supply and demand by applying linear equations. Organizations can optimize stock levels, minimizing costs, and maximizing service levels. Decision making through algebraic models. Businesses utilize algebraic models to support decision making processes. These models facilitate quantitative analysis, helping to evaluate alternatives and predict outcomes based on varying inputs. Exponents represent repeated multiplication, essential for understanding financial growth over time. Roots, conversely, are used for finding present values and calculating essential financial metrics, making them indispensable for investors and analysts alike. Compound interest utilizes exponents to measure the growth of investments over time. The formula highlights how principal grows exponentially based on the rate and time. Growth models often involve exponential functions, allowing businesses to project future revenues by applying the formula. Forecasts can be made that guide strategic planning and resource allocation. Exponential decay describes how certain financial metrics, such as depreciation, diminish over time. This principle aids in assessing asset values and making informed investment decisions concerning risk management. Roots are applied in calculating break-even points and optimizing quadratic equations. Businesses can determine the maximum profit by finding the roots of profit functions, thus enhancing strategic decision-making. Slope represents the rate of change in economic variables, illustrating how one variable responds to changes in another. In business, positive slopes indicate profitability or growth, while negative slopes may highlight losses or declines. Graphing allows businesses to visualize functions such as cost, revenue, and profit. This process helps stakeholders understand relationships and trends, facilitating better financial decisions. Interpreting graphs is essential for identifying patterns and making sense of complex data. Effective data visualization simplifies communication of results to stakeholders, aiding in informed decision-making. Trend analysis using graphs helps assess past behavior to predict future outcomes. It is integral for strategic planning, allowing businesses to adapt to market fluctuations and optimize performance. Market demand curves graphically represent the relationship between price and quantity demanded. Understanding this relationship allows businesses to set optimal pricing strategies and forecast sales effectively. Quadratic functions, characterized by their parabolic graphs, are essential in representing scenarios where relationships between variables are nonlinear. Their key properties facilitate the analysis of optimal outcomes, such as profit maximization and cost minimization in business models. In profit and loss analysis, quadratic equations help to identify peak profit points by establishing relationships between revenue, costs, and outcome probabilities. This enables businesses to optimize pricing strategies and predict financial outcomes effectively. Factoring quadratic equations allows businesses to break down complex profit models into simpler terms, facilitating easier analysis. This technique aids in predicting future revenues by simplifying seasonal trends and cyclical changes in the market. Quadratic equations are commonly used to calculate break-even points where total revenues equal total costs. These calculations enable businesses to determine the minimum sales required to avoid losses, guiding pricing and production strategies. Numerous companies utilize quadratic equations in decision-making, whether in optimizing supply chain operations or evaluating market strategies. For instance, product pricing models often incorporate quadratics to establish competitive pricing that balances